In today's video I want to explore a rather difficult trade idea that happened in the Euro 30-minute timeframe yesterday. This analysis will involve elements from the fractal flow and market maker methods simultaneously, and the market scenarios contain quite a bit of ambiguity. As a contrast to the simple example I uploaded yesterday, we are now going to analyze something a little more sophisticated. From number 1 to number 3, we can see price creating a lower low. That's fine, but if you are aware of how large traders operate in the market, you can see that there is a market maker signature between the market vector from number 2 to number 3. In other words, this market vector seems to be suspiciously organized to the downside. If we consider the reverse psychology employed by market makers, we have to be skeptical about calling this a downtrend. Keep this first observation in mind so we can counterpoint it in the future. After number 3, price began a slow and steady stirstep until number 8. We could call this slow rise to the high number to the minor flow of this market. The problem begins when the minor flow collides with the major flow in number 8. Observe that number 2 is a major high in this chart, and number 8 is poking this major high as a result of an upward minor flow. Notice also that price never closed above the high number 2, although it poked it a total of 5 times. The interpretation of this repeated poking of the high number 2 is the following. We have the minor buyers from number 3 trying to break the major sellers from high number 2. Every time the small buyers open the door of high number 2, the major sellers appear and close it. That's more or less what's happening in number 8. If large traders were not interfering in this market at all, the logical market bias here would be to the downside, but they are interfering as we saw at the beginning of the video. Let's go back and see what happened in the beginning for a second. Market makers brought the market down quite nicely from 2 to 3. In number 3 the retail traders were probably sure about how far down this market would go, which is exactly what market makers wanted them to think. Look at what happened next. The market started to go upwards. This is a difficult situation because we can create compelling cases for trades in both sides of the markets, and both of them could very well be correct. For example, we could sell the fractal candle down right after number 8. That would be a valid trade. However, by knowing the rationale of large traders, I'm always skeptical in these kinds of situations, and I tend to prefer the counterintuitive option. The counterintuitive option here would be to the upside, of course. This brings us back to that whole notion of the market flow paradox where the minor flow trumps the major flow. Just remember that in situations where you have this level of ambiguity, you can take advantage of the Parando's paradox in game theory, and you can end up playing for both sides of the market to see which one wins. In this case I tried to choose one of the sides of the market by considering the reverse mentality of large traders. This can certainly backfire, of course. Keep in mind that when you use the Parando's paradox, you will have to make sure you have good trade location in both trades, otherwise it's a pointless exercise. The long trade position you see in this chart was opened right after the fractal candle number 9, and the stop-loss order was placed below the minor solid structure number 5. Again, this is a counterintuitive trade, and I could very well be seeing patterns where there aren't any. I decided to try this trade because I was not in front of the screen when the short trade after number 8 popped up, which is by no means a validation to trade in number 9, but it is what I ended up doing. One of the interesting things that caught my attention around the number 9 was the upward frequency line tying the lower tails. That's usually a pretty good indication that the market will shoot up. The take profit of this trade is the stop loss multiplied by 3 to give me a 1 to 3 risk-reward ratio. Let's see how the market ended up responding, and then I will make some more comments. As you can see here, I was quite lucky in this example, and the market ended up shooting really high. Observe that if you have played both sides of the market as it would be suggested, you would lose 20 pips in the short trade and make 60 pips of profit in the long trade, resulting in a net profit of 40 pips. This would be the only way of counteracting the ambiguity of this type of situation and getting away with a profit at the same time. If you wish to learn how to trade like this, don't forget to visit the strategy store in the link in the video description. If you enjoyed the video, don't forget to click the like button, subscribe to the channel, and leave your feedback below. Thank you for watching.